2.7 million. That is how many people in this country have been pushed into paying tax on their savings interest for the first time since interest rates started climbing. 2.7 million people who spent years, sometimes decades, quietly earning interest on the money they had carefully set aside and never owed a penny in tax on any of it. And then the letters started arriving. Brown envelopes from HMRC, landing on doormats across the country, telling ordinary savers, many of them retired, many of them on fixed incomes, that they now owe tax on the interest sitting in their own bank accounts. Accounts they opened at their local building society 30 years ago. Accounts they have never thought of as investments or income. Accounts that, as far as they were concerned, were simply the place they kept the money they had already been taxed on when they earned it in the first place. Here is the part that most people do not understand, and it is the part that makes the difference between keeping your savings where they are and quietly bleeding money to HMRC every single year. The problem is not how much you have saved. The problem is where you are keeping it. There is a specific amount of interest above which HMRC starts taking a cut, and in 2026, with interest rates where they are and tax thresholds frozen exactly where they have been for 5 years, that line is lower than most people realize. There is also a separate, completely different threshold that has nothing to do with HMRC, a threshold built into the benefits system, above which a retired person can lose not just hundreds, but thousands of pounds a year in benefits, pension top-ups, and exemptions they would otherwise be entitled to. And the two thresholds interact in ways that nobody from the government has ever sat down and explained in plain English to ordinary retired people. I'm Elliot. Over the next 20 minutes, I'm going to walk you through both of those thresholds, explain exactly how HMRC knows what you are earning on your savings, show you the 5 most common situations where pensioners lose money they did not need to lose, and give you a clear, practical plan for keeping your savings out of the taxman's reach entirely, legally, using tools that already exist and that most retired people in this country are not using. Every step is free. Nothing here requires a financial advisor, and the difference it makes to a retired person's income over the course of a single year can run comfortably into the thousands. Before we get to the numbers, you need to understand something that surprises almost every pensioner I speak to. HMRC already knows how much interest you are earning. Not because they are investigating you, not because your account has been flagged, not because you have done anything wrong. They know because your bank tells them. Since 2016, every bank and building society in the United Kingdom has been legally required to report the total interest paid on every account to HMRC automatically, once a year, with your name and your national insurance number attached. This is not a suspicious activity report. It is not triggered by unusual behavior. It happens to every account, on every person, every year, regardless of the amount. HMRC receives the figure, feeds it into your tax record, and uses it to calculate whether you owe tax on that interest. If you owe tax and you are paid through PAYE, which includes anyone receiving a workplace pension, HMRC does not send you a bill. It adjusts your tax code. Your pension provider receives a new code, deducts slightly more tax each month, and the money disappears from your income before it ever reaches your bank account. Many pensioners notice a small reduction in their monthly pension and assume it is a normal adjustment. It is not. It is HMRC collecting tax on savings interest that you may not even realize you owe. If you are not on PAYE, HMRC will send you what is called a simple assessment letter, or a P800, telling you what you owe and asking you to pay it. And if your total savings interest exceeds £10,000 in a year, you are required to file a self-assessment tax return, whether HMRC asks you to or not. The system is automatic. It runs in the background. And it is designed to collect tax on savings interest without you ever needing to lift a finger. Which sounds convenient until you realize that it also means tax can be collected without you ever noticing it is wrong, without you ever checking whether you needed to pay it at all, and without anyone telling you that there were perfectly legal ways to avoid it in the first place. Here is the number that matters. And it is the number that 2.7 million people in this country crossed without knowing it existed. It is called the Personal Savings Allowance, and it works like this. If you are a basic rate taxpayer, you can earn up to £1,000 in savings interest each year without paying any tax on it at all. If you are a higher rate taxpayer, that figure drops to £500. If you are an additional rate taxpayer, the allowance is zero. Any interest you earn above that limit is taxed at your normal income tax rate. For a basic rate taxpayer, that is 20%. For a higher rate taxpayer, 40%. On every pound of interest above the allowance. Now, for years, this did not matter to most retired people. When interest rates were sitting at 0.5% or 1%, you needed an enormous amount of money in a savings account to earn more than £1,000 of interest in a year. £100,000 at 1% produces £1,000 of interest. Most pensioners did not have that much sitting in cash, and most were comfortably below the line. That has completely changed. With interest rates in 2026 sitting well above 4% on many ordinary savings accounts, the maths has flipped. At 4.5%, you breach the £1,000 allowance with just over £22,000 in savings. At 5%, the threshold drops below £20,000. For a higher rate taxpayer with an allowance of only £500, you cross the line with as little as £10,000 to £11,000 in the account. £22,000 sounds like a lot of money when you are 25. When you are 68, it is not unusual at all. That is a lifetime of careful saving, a redundancy payment set aside, the proceeds from downsizing a house, an inheritance from a parent who passed away years ago. Millions of pensioners in this country have exactly that amount or more sitting in a standard building society account, earning interest, generating a tax liability they never had before, and feeding a figure to HMRC that triggers a tax code adjustment they never expected and may never notice. The personal savings allowance is the threshold that HMRC cares about. But there is a second threshold built into the benefit system that can cost a retired person far more money, and it works in the opposite direction. This one is not about how much interest you are earning. It is about how much money you have saved in total. If you are on pension credit, or if you are thinking about claiming it, your total savings matter enormously. The rules are as follows. If your savings are below £10,000, they are ignored completely. The DWP does not count them at all when calculating your pension credit. If your savings are between £10,000 and £16,000, the DWP applies what is called tariff income. For every £500 of savings above £10,000, £1 a week is added to your assessed income, whether you actually earn that income or not. It is a notional figure, an assumption built into the calculation, and it reduces the amount of pension credit you receive. And if your savings reach £16,001, pension credit stops entirely. Not gradually, not on a sliding scale, it stops. The cliff edge is absolute. £1 over the line, and your entitlement to pension credit drops to zero. Now think about what that means in practice, because the cascade is brutal. A pensioner with £15,900 in savings qualifies for pension credit, which is worth around £2,600 a year on average. That pension credit also unlocks free dental treatment, the free television license for over 75s, the warm home discount on the electricity bill, maximum council tax reduction, free sight tests, and help with NHS travel costs. The total value of the package can easily reach £4,000 to £5,000 a year, sometimes more. A pensioner with £16,050 in savings gets none of that. Not one penny. The £50 of extra savings, earning perhaps £2 or £3 a year in interest, has cost them the entire package. I want to be careful here because I am not telling anyone to hide money or to spend it down recklessly. The rules are what they are. But if you are a retired person sitting on savings just above that £16,000 line, you need to understand what those savings are actually costing you when the lost benefits are counted. In many cases, the cost of keeping that money in a savings account far outweighs the interest it earns. And there are entirely legitimate things a person can do with that money. Home repairs, replacing an old boiler, paying off a small debt, making a gift to a grandchild, that bring the balance below the threshold and restore the benefit entitlement. If you think you might be near the line, call the Pension Credit Claim Line on 0800 99 1234 and ask them to check. Even if you are slightly above 16,000, the interaction between tariff income, attendance allowance, housing costs, and other additions to the pension credit calculation can produce surprising results. The only way to know for certain is to ask. This is where we move from the problem to the solution, and it is the part that frustrates me more than anything else, because the tool that fixes the single biggest issue on this list has existed for over 25 years, and millions of retired people are still not using it. An ISA, an individual savings account, is a savings account in which every penny of interest you earn is completely and permanently tax-free. It does not count toward your personal savings allowance. It is not reported to HMRC as taxable interest. It does not appear in your tax code. It does not generate a simple assessment letter. It does not trigger a P800. The interest simply accumulates in the account, year after year, and HMRC never sees a penny of it. You can put up to £20,000 into an ISA in each tax year. That is the annual allowance, and it resets every April. If you have £40,000 sitting in an ordinary savings account right now, you could move $20,000 of it into a cash ISA today, another $20,000 next April, and within 12 months your entire savings would be sheltered. The interest on the full amount would be tax-free for the rest of your life. No forms, no reporting, no tax code adjustments, nothing. And yet millions of pensioners in this country keep their savings in ordinary building society accounts, paying tax on every pound of interest above the allowance. Because nobody has ever sat them down and explained that the ISA does exactly the same thing with none of the tax consequences. The rates on cash ISAs are competitive with ordinary savings accounts. The money is just as accessible. You can withdraw it whenever you want, and the protection under the Financial Services Compensation Scheme is identical. £85,000 per person per institution, whether the account is an ISA or not. If you currently have more than £20,000 in ordinary savings accounts and you have not used your ISA allowance this year, that is the single most important thing you can do after watching this video. Walk into your bank or building society, open a cash ISA if you do not already have one, and transfer what you can. The interest earned from the moment the money lands in the ISA is tax-free, and it stays tax-free forever. This is the situation that catches pensioners who have already breached the personal savings allowance, and it creates a rolling problem that gets worse every year if nobody corrects it. When HMRC receives the interest figure from your bank at the end of the tax year and works out that you owe tax on it, they do not simply send you a bill for last year. They also estimate what you are going to earn in interest next year, and they adjust your tax code in advance to collect the tax on that estimated figure before you have even earned it. The problem is that the estimate is often wrong. HMRC assumes that the amount of interest you earned last year is roughly what you will earn this year. But interest rates change. Accounts mature. People move money, spend money, make large purchases. If your interest drops from £1,500 last year to $800 this year because you moved most of your savings into an ISA, HMRC does not know that until the banks report again at the end of the current year. In the meantime, your tax code is still set to collect tax on the higher figure. You are being overtaxed, month after month, on money you have not earned and may never earn. This works in the other direction, too. If your interest is higher than HMRC estimated, you will be undertaxed during the year and then receive a bill after the end of the tax year. Either way, the estimate is a guess, and guesses are often wrong. The fix is straightforward. Log into your personal tax account on gov.uk, look at the adjustments in your tax code, and check whether HMRC's estimate of your savings interest matches what you are actually earning. If it does not, you can update it directly through the online service or call HMRC on 03002003300 and ask them to correct it. The new code will take effect within a few weeks, and your monthly pension payment will adjust accordingly. This is something I would recommend doing every year, at the start of the tax year in April, and again whenever you make any significant change to your savings, because the automatic system will never catch up until the end of the year, and by then you have either overpaid for 12 months or built up a bill you were not expecting. This final point applies to every married couple and every civil partnership where one partner pays more tax than the other, and it is the simplest adjustment on this entire list. The personal savings allowance belongs to each person individually. If you are a basic rate taxpayer, you get £1,000. If your spouse is also a basic rate taxpayer, they get £1,000. That is £2,000 of tax-free interest between you. But if all the savings are held in one person's name, only their allowance applies. The other person's allowance sits completely unused. By splitting savings across joint accounts or individual accounts in each person's name, you can effectively double the amount of interest you earn tax-free. There is nothing unusual or aggressive about this. It is simply using the allowances that HMRC has already given both of you. If one partner is a non-taxpayer, meaning their total income, including state pension, falls below the personal allowance, the situation is even more powerful. A non-taxpayer does not just get the £1,000 personal savings allowance. They also get something called the starting rate for savings, which allows up to £5,000 of savings interest to be earned at 0% tax, on top of any unused personal allowance. In practice, a non-tax-paying spouse can earn several £1,000s in savings interest each year without owing a single penny in tax. This is not a loophole. It is the law as written, designed to make sure that people on low incomes are not taxed on modest savings. But it only works if the savings are actually held in the name of the person whose allowances apply. If all the money sits in one partner's account while the other partner's allowances go unused, the family as a whole pays more tax than it needs to. Sit down with your spouse and look at whose name the savings are in. If one of you is paying tax on interest while the other has unused allowances, move the money. A simple transfer between spouses is not a taxable event in the United Kingdom. There is no charge, no capital gains, no reporting requirement. You simply move the money and the interest starts earning tax-free in the hands of the person with the available allowance. Everything we have discussed comes down to 3 simple principles, and together, they will keep the vast majority of retired savers in this country out of trouble entirely. The first principle is shelter. Use your ISA allowance every single year, without exception. £20,000 a year can go into a cash ISA, and once it is there, the interest is tax-free, permanently. If you have savings above the personal savings allowance sitting in ordinary accounts, moving them into an ISA is the single highest impact thing you can do. It costs nothing, it takes an afternoon, and the benefit compounds for the rest of your life. The second principle is split. Make sure both partners in a couple are using their allowances. If one of you is a non-taxpayer or a lower-rate taxpayer, hold savings in their name first. The combined personal savings allowances, starting rates, and personal allowances across a married couple create a substantial tax-free zone that most couples are only half using. The third principle is check. Log into your personal tax account at least once a year and look at what HMRC thinks you are earning in interest. If the figure is wrong, correct it. If your tax code has been adjusted for estimated interest that you are not actually earning, tell them. And if you have savings anywhere near that £16,000 line, get a pension credit check, because the benefits you might be missing are worth far more than the interest you are earning. The personal allowance has been frozen at £12,570 since 2021. It will stay frozen until at least 2028. Every year it stays frozen, more pensioners are dragged into paying income tax. Every year interest rates remain elevated, more pensioners are dragged into paying tax on their savings. And every year, the state pension rises with the triple lock, while the allowance stays put. The gap between what you earn and what you keep gets narrower. None of this is going to fix itself. The frozen thresholds are government policy. The bank reporting is automatic and permanent. And the system, as I have said before and will keep saying until something changes, does not chase you down to tell you what you are owed or what you could be avoiding. It collects what it can collect, as quietly as it can collect it, and leaves it to you to notice. So notice. Check the accounts. Open the ISA. Split the savings. Look at the tax code. And if you have a parent, a neighbor, a friend who is retired and keeping 20 or 30,000 pounds in a building society account that has not changed in years, please share this video with them today, because the tax they are paying on that money is almost certainly optional, and the tools to stop paying it are already sitting there, waiting to be used. I'm Elliot. I sit down with the ordinary rules that decide how your money is saved, taxed, and quietly chipped away at in this country, and I explain them in plain English so that retired people can keep more of what is theirs. Shelter the savings, check the code, and stop giving HMRC money you do not owe. I'll see you in the next video.